lowest trading point on the 16th, and we transitioned into the New York midnight hour. At this moment, the highest high and the lowest low of the next 24 hours is going to be predetermined. Now, on the 17th of August, the market opens here in midnight. It continues into a small consolidation, trades just slightly above the 16th high, and then trades aggressively lower down into 4:30 a.m. New York time. It runs the previous day's low. Once it goes below that, it purges that liquidity to here. It's a purging of stops, because sweeping stops can still be traded lower, but the daily candle is predetermined to be bullish. So we're not looking at this down move and trying to short and try to hold for a down close on the daily candle. We're looking for an opportunity to go higher. So in your notes, you want to make sure you have stop sweeps above an old high or below an old low. They can still be traded through at a later time. A purging of liquidity is in line with the daily bias, because the algorithm that books price is always the same. It's reaching for liquidity, it's moving to a premium, it's moving to a discount, back and forth, all on a time delivery process. Nothing happens in the markets that is not directly linked to a specific time of the day or day of the week. The magnitude, okay, of how big these moves occur are based on the price level. You anticipate moves relative to time. The magnitude of the move is linked directly to the price level. We trade down to the previous day's low again. Right below these relative equal lows, we have sell side liquidity. It's purged. It's not just swept, it's purged. Why is it purged? Because the daily bias is bullish. So any run on sell stops or sell side liquidity, that is a purging of liquidity. Once this happens, it should aggressively move higher. It breaks above these highs, trades up to this high here, and prior to that high we have this low. So this low and this high. Now, why am I using this low and not, say, this low? 8 o'clock in the morning to 8:30, in that 30-minute window, every instrument that's trading at that time, they all start calibrating for that 8:30 in the morning news embargo. When that news embargo lifts, all the news starts flooding the marketplace. The algorithms are going to go start firing. This is your low, this is your high, and we start receding down into that range. Trades down into optimal trade entry, and inside of this last up close candle prior to this low. So you have relative equal lows here and a high prior to that low being ran. So this low that took out liquidity here, this is a bullish breaker, this candle right here. That's what I'm annotating there. So take that range out in time and extend it in time. So we're trading down into that breaker, into this dealing range, into an optimal trade entry inside of a day that's bullish with relative equal highs that have yet to be traded to. Now, this run above is not a purging of buy-side liquidity. Why? Because the daily candle is expected to be bullish. So this is a sweeping on stops. Notice how the algorithm creates a high and then another high, so we have relative equal highs. They're going to want to come back up there and finish that unfinished business. We already know that relative equal highs, there's going to be buy-side liquidity, so the market should reach up to that level. Okay, fine. What level should it reach for?